Welcome back. This is video number 13 in our February series of Quick Strike tutorial videos. Today we are going to cover vol tools, vol term structure. We're going to do this in two parts probably, and probably not contiguous parts because second part, you don't need so much to get started with this tool. It is a little bit more complicated, so I wanted everybody to get a chance to play with this page. In the most general sense, and then we'll work our way down into the more complicated sections. But for now, we're going to cover a majority of what this page has to offer. As usual, I like to point out where we are, right? We have our main menu structure up here to move us between the different sections of Quick Strike. We select our product group, which then gives us our products within that group. Here's little controls for PDFs and refreshing and message center and economic event calendar, as well as a little notepad, right? And when we log in, we land on the market dashboard product overview where we are right now. Okay, and this term structure chart, we see this on the product dashboard, but we're going to dive a little more deeply here and take a look at it as a tool itself. So here we are in the vol term structure. So basically what you have here is you have all of the expirations. Now you see it says these little hashes with the Feb 16. This is the 1st of February, the 1st of March, the 1st of April, et cetera. And then you're seeing where these expirations fall. So if you click on them, you're going to see that it's got expires 2/24, 11 days to expiration, settle vol, current vol. Since we are on a Saturday, we don't have any intraday market stuff going on here, so we're not going to see any difference between a current and a settle volatility at this point. So we're looking at the money. The default to this is the at the money volatilities for each of these expiration contracts. And you see in this value section, again, like we've been talking about the whole time, you see text with an icon next to it. That means it's generally a drop down, and you can do things to make changes on the chart that's being displayed at this time. So right now you see that the radio button for the at the money is being shown, and we'll cover that. You can actually show the term structure for a lot of different things here. You can show for any delta call, any delta put, for any delta risk reversal, which would be in the way we're defining it in Quick Strike is a call minus put volatility, and then from a moneyness standpoint. So really powerful tool in terms of seeing what the term structure or what the volatilities across a certain period of time look like, right? So this is going to give you a nice idea of what the market's doing. Okay, so let's just take a look at the chart. As I mentioned, you can click on these and you can get details about what's going on with that chart. You're going to get to expiration days, the expiration date, the volatilities. Okay, the display settings. Let's look here and see how we can make the changes show up on the chart here. So we're showing right now. We're showing the current vol. Traces and labels. This is defaulted on, but in a mode that you can't see that, so we don't have to worry so much about that. If we check the box to show settlement vol, right, we're not going to see anything today, right, because we're going to see it on the legend, and you see maybe a little bit of blurriness now because there's another plot underneath there. But since we're on a Saturday, there's no intraday market, you're not going to see any changes there. So we could probably check that off for the time being. Show weekly. So typically what we do within each product is the weeklies can sort of gum up the front of the curve. So by default, we don't put those in there. But if you check that box, you can have them populated, and you see, since they're pretty tight next to each other a week's worth of time, sometimes it throws things off a little bit. And if you get real close to expiration, there is a chance where the weekly gets really high in terms of volatility to keep it at a particular price. So the chart will get kind of a little bit messy at those times. So we default it to show weeklies off, and that little piece is gone then. And the gold weeklies, they have some open interest. They're not super active, but they do have some open interest. But generally speaking, this is enough to get you, when people think of the term structure, not really thinking of the short dated stuff so much. Also, what we have here is we'll come back to this show first, second, and third implied forward. That's a little bit more complicated and ties into what we have going on over here. We may cover it today, and it depends on how long we go. We're going to see here. And then finally, there's a plot versus date. So in this case, we're showing the date here of the contract, and we can change this to plot versus days to expiration, and it should look the same, but now it's going to tell you how many days to expiration each one has. So some people like looking at it as an absolute date, and some people like looking at it as in terms of a days to expiration. It depends. This is kind of I like this sometimes. It depends how I'm thinking or what I'm looking at. Okay, so we're going to push it back to the default. And then finally, here's the cutoff. So right now we're showing 1 year's worth of contracts, which is typically where a lot of the activity is in these markets, in most of the markets. But if you wanted to see more, you can turn on more and plot more. Let's take a look at what 2 years looks like, see if it looks kind of crummy. Oh, it looks pretty good. So there's 2 years worth of data. So, you can change that as you see fit in terms of what you want to take a look at. Okay, so we talked about this a little bit. Right now we're showing the at the money. If I wanted to show like a 25 delta risk reversal term structure, I can change that, and that's what it looks like now, right? So this is basically saying that the call minus the put volatility, the net volatility of the call minus the put is around 3.25, and you see how the chart travels along. So again, if you're looking for that information, really simple, real easy to get here, and we show all the different delta values here, so you can get out those fairly easy. And then if you want to see individual delta volatilities and stuff like that, so you can see how a part of a curve looks from a volatility standpoint in relation to each other, you can do that here as well by selecting one of these radio buttons and pulling down from the drop down as well. So we're going to stick with that, the money, for the general explanation, because it's it's what's typical in terms of talking about the vol term structure. Okay, so we're going to hop over this forward dates, and we're going to jump over to this historical section. So if I click on that, I'm going to get a drop down, and we give you some choices to look at in terms of comparison. So if I want to, you can look at 1 week, 2 week, 3 weeks back, or you could check all of them on if you want. You could check one on, but let's put one on now at first and see. So now we see that there's been quite a jump in volatility over the last week in the metals, and let's see how that plays in from 1, 2, and 3 weeks ago. So we're probably going to see, it was pretty stagnant here for a period of time, and then there was a nice move in volatility here. So let's just take a quick look at that while we're here. Let's go to the pricing sheet really quickly, and then let's look at this, and let's look at the 1 month's worth of, and we see here's a good guess as to why there was a big change. So we were pretty much in a channel here between 10.50 and 11.50, and then we broke out here and moved up $100 in the gold contract. So that might be a pretty good explanation of why we're seeing this big gap in volatility here. Let's go to the 3-week gap here and see over the last 3 weeks. And if we throw in 1 month, let's just throw in 1, 2, and 3 months and take a look. Okay. And we're seeing sort of the same thing. Okay, so big move. We are pretty flat. Big move in the underlying caused a pretty big jump in the volatility, but it's a nice, easy place to see that pops out at you right away. So I like to use this during the day. I always keep the show settle vol on so I could see what's happening from a movement standpoint intraday, and occasionally I'll throw the 1 week on just to give myself some bearings in terms of how today and the settlement look in relation to a little bit ago, right? Depends what your horizon is in terms of the analysis that you're trying to make. Okay, so so we looked at the display settings, right? You can plot a lot of different things here, the value, a lot of different values you can plot here as well. We looked at the historicals. Now the forward dates, this is interesting. So let's do something here first. So let's show first implied forward. Okay, let's click that button and talk about what that means. So basically, what we have going on here is the following. It says that if March trades the way it's trading from a volatility standpoint for the amount of time that it has left for its number of expiration days, then the expectation is that April will be trading around this green bars level. So if you click on it, it's going to give you the math to show you how that's taking place. Same thing goes over here. It's saying if April trades at its volatility value level for the next 73 days, then the expectation is that May is going to trade around this level. So this is called the first implied forward, and we're going to turn that off, okay? And we're going to show a little bit different version of that as well. So let's go back. Let's keep it on for a second so you can see. So basically what it's telling you is that given that there's some real market knowledge here, and these volatilities are really what they are, and the market's going to trade that, you have a pretty good idea of what the next level is going to be for the month that ends up being the front month once these come off the board. Okay, so that's what these green bars are showing you, and if you click on them, and it's going to talk about the math behind that. Okay, so it's a pretty good explanation here, and we also give you a wiki article if you want a little bit more detail. So let's go, and then you can do the same thing for first implied, second implied, and what first implied means it's taking a certain number of days off. Second implied means it's taking the next number of days off, that kind of thing. But I would say we're going to come back to this in a little bit more detail, so we tie that in with what's going on over here in the tab, but I wanted to at least show you what was happening over there. So I'm going to turn that off. And then finally, a quick explanation, because we're already at like 10.5 minutes on this video, quick explanation of this forward dates. So what we're showing here is, you see it's got every contract that we're seeing in this term structure here. So let's just check this one, the March contract, and say, okay. So now what we're saying, when we check this forward date, it's saying essentially what we talked a little bit about in this first forward. If March trades at this level until it expires, the expectation is, and if, let's not say March, if the market trades at this level over the next 11 days, then the expectation is that the volatility of these other contracts is going to come down, because essentially what it's saying is that this volatility for 11 days plus this volatility for the next amount of days is going to be equal to what this volatility is right now. Okay, and that's where those yellow pop-ups with the math comes in to get you to this chart. So the way I think about it and the way I describe it, and I think the best way to sort of keep it in mind and to utilize it is saying, if March trades at the level that the market expects until it expires, then we're going to see the term structure is going to look like this when April becomes the front month. Now let's uncheck this one and check April. Now what this is going to say is the following. It's saying that if April trades, if the market trades like April for the next amount of days, in terms of days to expiration is 44 here, then the term structure when May comes into play as the front month is going to look like this, right? And it sort of makes sense, right? Because you have a higher volatility taking place for a period of time, which would require this remaining volatility for May to not be so high once it becomes available as the front month. So it takes some thinking, but I think it's very useful in terms of sort of a little bit of a forecast of what volatility is going to do if you believe that the market is right in pricing these from a volatility value. Okay, so that's in the forward section, and you could check any one of these to see what it might look like if everything stays the same in terms of the current volatilities, and how's the curve going to move forward. But the reality is, you're typically going to use it in the first or second one, because even the first one seems to be like the one that makes the most sense, because it's the shortest amount of time, and in all likelihood that has the greatest chance of acting the way it is right now. Okay, so we'll put this okay. That'll tick this off again. Now again, like we said, the vol term structure, there's a lot going on over here, and this is going to help explain some of the forward items that we talked about, but we're going to come back to this. I think right now the best thing to do is to play around with the display settings and see how that affects the change on the vol term structure chart. Look at the value, really helpful in terms of thinking about the curve, not just as an at the money, but as a multi-purpose delta curve, right? So you can look at all of the deltas so you can look at any part of the vol skew curve there by changing the call delta, put delta, and or even selecting the skew. So it gives you a nice detailed way to look at what the volatility in the market is doing, and then compare those volatilities between the expirations to get a good idea of what the market's thinking about. Upside potential, downside potential, that type of thing when you start looking at skew. So lots that you can analyze here, lots to play with, and I just encourage you to knock around. And if you have any questions, shoot us an email over here at support, like we've talked about before. Click on the support button and send us a comment feedback, you see a bug, see a new feature, change, just a question, anything like that. Okay, so thanks again. We'll come back to vol term structure at some point when I feel like everybody's gotten a chance to play with these other videos. And if you have any questions in the meantime, let us know. But stay tuned. We'll have another one coming up here soon. And I hope the videos have been helpful. I hope you enjoy. Thanks a lot.